So we're in the topic introduction to groups. So today's topic is regarding groups, right? So let's go ahead. So under introduction to groups, you are going to study about certain types of investment. Like the is meant by control and what are the criteria to be met to really assume that there is a control of one company over the another company. We are going to see some definitions. We are going to see how, like the separate statements which are made by the parent and the subsidiary, right? We are going to see parent statement of financial position, and we are going to see how group financial statements are made. Just a second. Then how to prepare the group financial statements we are going to see, and how to like what is the way to prepare consolidated statement of financial position. We're going to see how to calculate goodwill, okay, which is something new for you. We're going to see what is non-controlling interest, right? We're going to see the recognition, how they recognize goodwill, how measure it initially, how to calculate, how to measure that, and then as well as impairment of the goodwill as well as we're going to see that. Okay, so let's go ahead and see what these all mean and understand clearly. Now, introduction and definitions under that. Acquisition of another entity. There is a company A which wants to acquire company B. So how company A is acquiring company B is, we are going to see here, like the acquisition happens in what way as per the concept here. A company may expand or diversify. So either it wants to expand, so it can acquire another company, or if it wants to diversify, it can acquire another company. So how if a company is of $1 million worth, and if it acquires a company B which is even $1 million worth, so these two companies may become $2 million worth, right? So it's expansion. Or company A is in India, company B is in like Africa. So if they acquire company B, they are diversifying, or they are expanding because they have operations in other countries as well. Or if company A is into car manufacturing, company B is into bike manufacturing. Now the business has got expanded because two types of products are being manufactured. So a company may expand or diversify its operations by acquiring another entity. There are different ways in which an entity might acquire another business. What are the ways in which an entity might acquire another business? Acquire sole trade. A company can acquire a sole trading concern. They can acquire a partnership firm, acquire like the assets and liabilities of some company, add assets and liabilities to statement of financial position, and now own as now owned. Okay, just a second. Now, so a company, let's say here we have a company, it wants to acquire a sole trading firm ABC. A company wants to acquire a partnership firm, the sole trader here, partnership firm XYZ. A company can acquire the assets and liabilities of those companies or firms. What they can do is they can add those liabilities and assets to its own assets and liability in its statement of financial position. That shows now the company A has owned these companies. If they are owning any of them, profit and loss which are generated by sole trade partnership assets are reported in profit or loss. Yeah, see what happens if those companies are acquired by a company. Now those are also operating, and whatever the income they generate or the profits or loss they make, okay, now should be shown in the profit or loss statement of a company. Okay, so profits and losses which are generated by sole trading or partnership assets can be termed as investment income, are reported in the statement profit or loss statement of this particular company which has acquired any of these two firms, right? Now, or a company can do one more thing. So this is not the this is not something we are going to study, right? This is what we are going to focus. A company can acquire another company which I name as B. How come they can acquire B company? By acquiring the shares of that company. Let's say A company here we have and B company here we have. B company has a share capital of $100,000, whereby they have issued 100,000 shares and each share is costing $1, and A company buys or purchases 70,000 shares of B company. Okay, and the market value of the shares are also $1, let's say. So A company has acquired 70% of B company, hence A company is the parent, B company is the subsidiary. Okay, so more than 50% if some company is acquiring in another company. Let's say here A is the one which is acquiring and B is the one which is acquired. So if A has more than 50% shareholding in B company, then B is called subsidiary of A. Okay, less than 50% or more than 30%, if I say 30 or 25, let's say, we'll see the specific percentage. So if the investment is between this and this, it will be called as associate. If the investment is like, let's say 7 to 8, like less than this, less than 25%, let's say 7 to 8%. In A company has 7 to 8% investment in B company or 10% in B company, then it's called general investment. Right? So this is what we have seen, and when A company acquires 70% in B company, this is my example. This is called the A will be called as parent and B will be called as subsidiary. They can maintain separate statements, but at the end of the year they have to consolidate. Okay, so assets and liabilities of A and B will be added together, and then we'll be making a group that will be called as a group statement. We'll be showing that or preparing that group statement at the end of the year, right? So let's see some points here. Investment in parents accounts represents ownership of shares, which in turn represents ownership of net assets of the so you'll be seeing the balance investments they will be showing of suppose 100,000. This is nothing but the parent company has acquired 100, like let's say 70,000, let's say. So parent company and this will be investment, and in the statement of financial position of the subsidiary, they will be showing share capital of like 100,000, right? So now the investment of parent in subsidiary is how much? 70%. So rest of the 30% belongs to whom? Non-controlling interest. What is that? Come on, tell me. Hello.
Non-controlling interest.
Non-controlling interest. Yeah, that you have already like have all the videos. You have already seen that, right? Now, next point. After the transaction, so now here we can see investment in parents accounts represents ownership of shares, which in turn represents ownership of net assets of the acquired company. So investment, so here we can see that parent has got net assets. So what do you mean by net assets? Net asset is nothing but total of assets minus liability. What do you mean by total of asset minus liability? It's nothing but equity, right? So this particular 70,000 investment in B company shows the equity of A company in B company, right? That's called net assets. Now, after the transaction, the subsidiary will continue to exist as a separate legal entity. Of course, at the end of the year, they will be making group statements. Okay, I have already explained to you. Now here are some points. Now investment subsidiary. So parent has control over subsidiary. Parent A has control over subsidiary. We'll again see in detail what is control. And then at the end of the year, full consolidation should happen. Now, because A has 70% stakes in B company or shares in B company. A has 25% stakes in B company. These two are associates. And here A has what over B? Significant influence, not control. We will again see what these are. And here the accounting comes into picture is equity accounting, not consolidation. You will be learning what is equity accounting afterwards. A has 10% investment in B, that's called general investment. So investment which is none of the above, that is investment which is not subsidiary or not even associate, is what? General investment. And
General
here asset
investment.
held for, yeah, asset held for accretion of wealth. That means the motive is not to run another company or like work together with that company, okay, but the intention here is to just hold some stakes as an investment. That is nothing but accretion of wealth. That means, you have some wealth, like you invested 10% in many companies, that much you can show that you have that much of wealth. So here we will be such kind of investments, if it is done, will be under the scope of IFRS 9 financial instruments, right? This chapter is to be done now. So definitions, let's come and understand. Control. So an investor A controls investee B when the investor is exposed or has rights. So A has rights to variable returns. B's returns will not be fixed returns, it will be variable returns. And A has the right to get returns, like because A is an investor in B. So being an investor, the investor's rights are very clear that they are entitled to get returns from their investment target. Okay, so A should get the returns from B. Returns are variable returns because A has an involvement with the investee B, and A will decide what A wants to do with that return because A has that power over the investee, that is B. So very clear, A is an investor in B, B is an investee. A has right to get returns, like a share of returns, or A has a right to get returns for its investment or involvement in company B or investee. And what should be done with the return, A will decide, right, because it has power over B. Now, power, existing rights that give the current ability to direct the relevant activities of the investee. That means what activities B is performing, all the relevant activities or most important activities where all monetary transactions are required, are involved, or some like activities which B, being under the control of A, cannot do it and without A's direction or without A's decision making, right? So whatever the most important activities, let's say they want to repay a very big amount of debt, they want to B company wants to acquire another company called C. So all these things, who will decide? A. That shows A's power. So A has the right and current ability to direct. So A under, like, it will be with A's direction that B will be performing most important activities. Yeah, B is a subsidiary of A because A has control over B, or it is or B is controlled by A. Some company which is controlled by another company is called subsidiary. Parent, because A is controlling B, A is parent. Both of them clubbed together will be called as group. Associate, I have already explained that if A has 25% stakes in B, A and B are associates, A has significant influence over B. Okay, you cannot term associate as joint venture as well. Significant influence is nothing but A like has the power to participate in the financial and operating policy decisions of B. And the directors of A can also be a part of B's board. Okay, A does not have total control, but they have joint control, right? B's director and A's director will be jointly deciding, or they have joint control over the policies. So already we have discussed about control. So there are some points here. What is control all about? We will be learning in details. A parent or investor only has control of the potential subsidiary investee if it has all of the following. So very clear, A has uh, control over B. That means a parent who is investor. So the parent here according to me, or the investor here according to me, is A. A parent or investor A only has control of potential subsidiary. That means the one they want to acquire, okay, or almost acquired, that is B. If it has all of the following, that means A has a control over B if all these criterias are satisfied. So A's control over B will be decided only based upon all these criterias. Let's see what are the criterias. So power to direct relevant activities. What does that relevant activity mean? I have already given some hint to you. So examples of power, voting rights. Okay. So A has, majority of the voting rights with them. Why? Because A has the majority shares. A can A has the right to appoint, reassign or remove KMPs like company secretaries. Are you understanding?
Yes, sir.
A has the right to appoint or remove another entity that directs relevant activities, like a very big customer, let's say, who always have who pressurizes the company B. So whether to continue with them or not, they will decide. Decision making rights stipulated in a management contract. Examples of relevant activities: selling and purchasing goods, services, selecting, acquiring, disposing of assets, researching and developing new products, process, determining funding decisions. All these are done by A. Exposure of variable returns. So dividends, interest from debt, changes in value of investment, like investment value is going up or down. That is called variable exposure to variable returns. And investor A only has this ability to use power to affect the amount of returns. So what they have to do, they will decide with that. Okay. There is a question here in front of you. I want you to solve this activity. Come on, read this.
So more question is there.
Yeah, I'm showing.
Done, sir.
Yeah, what is the answer for this?
Element.
So the question here is
As it has control.
yeah, I'll show the like answer part
Mm.
as well for so that you can refer. This is the answer part.
It has voting.
What can be the answer?
So once again, show the question also.
Yeah. So Alpha company, Alpha acquired 4,000 of 10,000 equity voting shares. So Alpha acquired 40%, right? And 8,000 of 10,000 non-voting preference shares in Crofton. Preference shares are not important for us. Alpha acquired 4,000 of 10,000 equity voting rights in Element and has signed agreement giving it the power to appoint or remove all of the directors of Element. So Alpha has acquired 40% equity voting rights as well in the company called Element.
Element.
This is Alpha, this is Element, right? So when they acquired 40% voting rights in Element and had signed an agreement giving Alpha the power to appoint or remove all of the directors of Element. So what is the answer to you? Answer for this. Now, which
Element.
investment would be classified as subsidiary of Alpha? Here there are two things, right? Crofton is also there. Yeah.
But it's not giving power.
Sorry. Yeah, see that preference share I said it's already like it's not something to be considered. See, for that you have all these things right here to understand, right?
Yes, sir.
So decision making rights stipulated in management contract. Is it a point here?
Yes, sir.
So when this is a point, what does it show? That the parent has power over the subsidiary or not?
Second point also, sir. Right to appoint or remove.
Yeah, right to appoint or remove is there, but this particular thing, like by default comes when there is more than 50% investment, right? Here the investment is of the 40%.
But only we need to show whether it is having control or not.
That's what I'm saying. So that for that reason, here first they should have a contract with them. Okay. As per that contract, the removal can be decided, right? Hello.
Yes, sir.
So the contract is an important element, and then right to appoint or remove comes. So as there is a contract, they can
Yes, sir.
remove signed agreement, right? So what does it show? The like the investment would be classified as subsidiary of alpha. Which one? Only element. Am I right?
Yes, sir.
Yeah. So it does not have power over Crofton. Why? Because that is from the perspective of preferred shares. Agreement here is between alpha and element. So element will be a subsidiary because they have an agreement, written agreement between them. Now, parents separate financial statements. Before we consider the consolidated financial statements, we must first look at how the investment in the subsidiary is presented in the parent's individual financial statements, right? So first you will be getting some idea about this, how it goes. So parent's statement of financial position under International Accounting Standard 27, separate financial statements. Investment can be recorded in the parent's separate financial statements either at cost or at fair value. Okay, so at cost, assumed in this, so we are taking it because it has been assumed accordingly in this course. Fair value as financial asset under IFRS 9, and using equity method, like only in case of only likely to be adopted for investments in associates. So equity method is only applicable when there is an investment in some company which you have done, which makes you and that when a company does some investment in B and these two are termed as affiliates or associates, then this method is applicable. Okay, so cost is what we will be considering most probably. So in front of you there is a question, so we will be referring this what is happening. So examples of parent statement of financial position. Statement of financial position of Porter's company and Sanus company are as follows. Porter's company is given, Sanus company is given. PP investment in Sanus company at cost. So parents investment in Sanus is of how much? 13,800, right?
Yes.
Now the current assets are given, and here you can see like Sanus company. So parents investment is given, current assets is given, equity. So here it is Portus, here it is Sanus, right? Clear? Sanus company. And reserves are given to you, Portus and Sanus. And then the total of reserves and then non-current liabilities given. So what is that they're saying? On 31st December 2004, Porter's company purchased a 100% holding in Sanus company for $13.8 million in cash. So what is that? Can I say this is $13.8 million? And Porter's has given this much, and it has acquired all the shares of Sanus company. Am I right or wrong? Come on, tell me.
Yes, sir.
So they
Yes,
have
sir.
paid excess. They have paid excess. We will study afterwards what is that excess amount called. So it shows investment in Sanus company at cost. This will remain unchanged from year to year. That is post acquisition increases. So yeah, the investment value will increase as the year passes by, right? Now, I know that the investment shown here is like 2400 and there they have paid how much? 13,800, right?
800. Yes.
Yeah, so
7,400 extra.
yeah, so extra they have paid to acquire this company. That we will study. That will be termed as goodwill. We will study afterwards. Now, group financial statements. Requirement to prepare group financial statements. When a parent acquires subsidiary, it is required to produce an additional set of financial statements known as group or consolidated financial statements, which aim to record the substance of its relationship with its subsidiary rather than strict legal form. So see, legally, what happens? Parent may not be 100% owner of subsidiary. At times, there can be a partial acquisition as well. If parent is also 100% owner of that company, company B, okay, both are operating separately, but since it is investment of A, henceforth substance is given more importance because economic benefits will be derived from the subsidiary company than the legal form. As we are studying accounting, we will give more importance to substance rather than legal form. Okay, now features of consolidated statement of financial position. The group or consolidated financial statements present the results and financial position of group of companies as if it was a single business entity. Yeah, so suppose land is there of A company as like $100, and land of B is given as $50. So now land of A plus B is how much? $150, right? So now this A plus B, can I say this is a single entity now? Come on, tell me. I'm asking something, yes or
Yes, sir.
no? Yeah. So present the results. So what is happening? The group or consolidated financial statements are prepared for what purpose? To present the results and financial position of a group of companies as if it was a single entity. We are showing the group statements to show the performance or financial position of the group.
Yes.
Okay. Now, because
Yes,
they
sir.
have become a single entity now, so are issued to shareholders of the parent. Now, are issued in addition to and not instead of parents' own financial statements. Okay, so the consolidated statements are issued in addition to, but don't take it like they are prepared instead of parents own financial statements. Parents financial statements are prepared, along with that the consolidated statements are also prepared. So provide information on all companies controlled by parent. Show no investment in subsidiary, instead the assets and liabilities of the subsidiary are included. Show share capital of the parent only. See, this is what happens when you consolidate. While you consolidate, you don't show the subsidiaries share capital. Okay, and for that case you also don't see, this is A company, B company, when they are maintaining separate set of books. So investment is shown in A and share capital is shown in B. Okay, but when they consolidate and become A plus B, do you think A has like now they are one company, right? One
Yes.
company, right? Now do you think any investment has happened and any share capital has like B has got any share capital? Do you think it is like that? So this is a person, he is wearing a shirt and there are two pockets to it. So 100 rupees he puts from one pocket to another pocket, right? Do you think the money has grown?
No.
That's what. So if if A does the investment in B and they maintain separate set of books, it will be seen in their statements like B has got some share capital from some investor and A has done some investment in some company. But when they become one company in the sense what? No
Consolidate.
investment, no share capital. That is consolidated. You will
Yes.
be cancelling this too. Isha, did you understand? Isha, I'm asking, did you understand?
Yes, left, sir.
Why? No connection. Okay, maybe some problem with connection. Two minutes. Yeah, just wait. Okay, let's continue now. So it's very clear, like if A has invested some money in B, let's say A has in the share, the journal entry for A's investment in B will be what? Investment in subsidiary to cash, right? And what will be the
Yes.
entry for the subsidiary company? It will be cash to share capital, right? So when they make the books, statement of financial position of the parent and statement of financial position of subsidiary. So here like I'm making T format, okay, balance, like I'm making balance sheet in ledger format. So they had a cash of 100,000 and out of that they invested how much? 50,000, let's say. So 50,000 cash is out, right? So 50,000 has gone cash and 50,000 investment has come, right? Now how much is
Yes.
the total value? Still how much?
1 lakh.
1 lakh. What is the capital the subsidiary got? 50,000. What is the cash the subsidiary got? 50,000.
50,000.
These two are
Yes.
separate set, right? Separate set of books. When you consolidate and make TS company, what happens? You already know that when they become one company, that means all these activities which has happened will be presumed that they haven't have happened, finished. Why they haven't have happened, it will be presumed because since there were two different companies, this activity what has happened is evident and very clearly seen in their books. But if these two are one company, then what is the, like what is the investment which has happened, what is the amount which has gone? Nothing, right? So what
Yes.
happens? For that reason we will cancel the investment here and capital here. Okay, we cancel this, right? How much cash you are seeing here? 50,000.
50,000.
How much cash you are seeing here? 50,000.
50,000.
Now total cash is how much?
Left with 50,000.
Why
Total
50,000?
total 1 lakh, but left with 50,000.
For what reason? The investment is not there, the capital is not there. So here 50,000 was there, right? And here
Mm.
you have already put some 50,000, but when you show them as one company, these two got cancelled, investment and capital. This 50 and this 50 make how much? 1 lakh. That means how much you had in the beginning, the same amount you have here. Did the amount change? Hello.
No, no.
What am I asking? There is 50,000 left over here. Here, right?
Yes,
You
from one
invested. Now
pocket
you,
to another pocket.
yeah, you cancelled. So what has
Yeah.
happened? 50 here, 50 here. Now the total cash is 1 lakh finished. So that
Yes.
much, what was in the beginning, the same is here right now. So nothing has changed. That means if you put money from one pocket another pocket, you're having the same money. It hasn't increased, right? Now. So we will be showing only the capital of the parent here. That is what is important. No capital of subsidiary will be shown anywhere. Now, shows the equity owners of the parent company, the consolidated net assets of the group. Okay. That means the equity owners of the company are only the one like whose share capital will be shown. Shows the asset and liability. Yeah, you will be clubbing and you will be adding up and showing in the group accounts. Now, how to find out goodwill and what is goodwill? So a simple example I'll be giving. See, if parent is acquiring subsidiary and the total net asset value, as net asset value is nothing but here everything is given to you. So let us say parent is acquiring the subsidiary and the value of the subsidiary's business is in this way calculated. Value of the business as a whole. Cost of the investment plus any non-controlling share not purchased. Okay. If like this is exceeding the fair value of the net assets acquired. Okay. That means uh, if at all, this entire cost what you're taking is 1 lakh. Okay. And what the parent is paying is 120. The excess amount here paid is what? Intangible asset goodwill, correct? Hello. Hello.